If you heard that you can move to the Canary Islands and pay only 4% corporate tax, this video is for you. Because yes, the 4% tax exists, but no, it's not what most people think. And the biggest mistake we see is not that people try to use it, it's that they try to use it without understanding how it actually works. We are tax lawyers and advisors working daily with international entrepreneurs relocating to the Canary Islands, and almost every week someone comes to our office saying the same thing. I heard I can set up a company here and pay 4% tax. What they usually don't know is that the 4% regime, the Canary Islands Special Zone, the ZEC, is not a discount coupon. It's a structured legal regime and it requires real substance. So what is the 4% tax really? The Canary Islands are part of Spain, and in Spain general corporate tax rate ranges between approximately 15 and 25% depending on circumstances. However, under the ZEC regime, qualifying companies can apply a flat 4% corporate tax rate on eligible profits, which make it the lowest corporate tax rate in Europe. But here is the real question. Can you actually qualify to access the ZEC regime? You must create a real company with real economic activity in the Canary Islands. On the capital island, this means an initial investment of at least 100,000 euros and the creation of at least 5 full-time jobs. On the non-capital island, the requirement is 50,000 euros and at least 3 employees. There are not flexible recommendations, there are legal requirements. So, if you are a freelancer working alone from your laptop with no intention of hiring, this regime is not designed for you. Another very important clarification, the 4% applies to corporate profits, not to personal income. Many people confuse this point and assume that everything they earn will be taxed at 4%, which is simply incorrect. If you distribute dividends to yourself, personal taxation applies under Spanish rule, so your effective tax rate depends entirely on how you structure your income, whether through salary, dividends, reinvestment, or holding structures. This is where real tax planning begins and where superficial comparisons usually fail. Now, let me be very clear. For the right profile, this regime can be extremely powerful. If you are running a scalable business, for example, technology, international services, or safety in trading activities, and you are prepared to build real substance in the Canary Islands, the tax advantage can be significant. 4% corporate tax combined with other incentives such as the investment reserve in Canary Islands can dramatically reduce the effective tax burden if the structure is coherent and properly implemented. However, the mistake we see repeatedly is that people focus on the percentage and ignore the structure. They compare the Canary Islands with Dubai, Andorra, or Estonia without understanding the operational requirements and compliance obligations. And they assume that changing geography automatically creates tax efficiency, which it does not. Tax efficiency comes from structure, not from location alone. There is also another misconception that needs to be addressed. The Canary Islands are not a tax haven. They are part of Spain and therefore subject to Spanish tax law, Spanish reporting obligations, and Spanish compliance standards. The ZEC is not a loophole. It's a regulated incentive regime within the European Union, and precisely because it is regulated, it can provide legal stability if used correctly. So, who should seriously consider the 4% regime? Entrepreneurs with scalable operations, business capable of hiring locally, founders planning a medium to long-term relocation, and individuals seeking legal stability inside the European Union while optimizing their corporate taxation. And who should not consider it? Short-term digital nomads looking for a quick fix, freelancers without hiring capacity, individuals attempting to replicate the structures seen on social media, and anyone unwilling to invest property and commit to building real presence in the Canary Islands. The Canary Islands can be an exceptional jurisdiction, stable, European, and tax efficient when structured correctly, but it is not automatic and it is not universal. The 4% tax exists, but whether it works for you depends entirely on your business model, your investment capacity, and your long-term strategy. Before making any decision based purely on a percentage, make sure you understand the legal and operational structure behind it. Because in international taxation, what appears simple is usually structural, and what is structural must be planned correctly from the very beginning. If you find this explanation useful, consider to subscribing the channel. In our next video, we will explain how tax residency interacts with corporate structures in the Canary Islands and why many entrepreneurs misunderstand that path completely.